Hey everyone, welcome back to Corporate Decoder. Today, we're diving into a report from Goldman Sachs Real Estate Finance Trust, and let me tell you, it's got a few twists and turns that might make your head spin faster than a roulette wheel in Vegas. Think of it as a financial magic trick where they're trying to make expenses disappear or at least reappear later. So first up, the company, which we'll call GSREFT for short, has a new agreement with its advisor, Goldman Sachs & Co. LLC. It's called the Expense Support Agreement. Basically, Goldman Sachs can choose to pay some of GSREFT's general and administrative costs until early 2027. Think of it like Goldman Sachs picking up the tab for office supplies and other day-to-day expenses. It might seem generous, but there's a catch, as there always is in the world of finance. Here's the kicker: if GSREFT makes enough money, specifically if what they call distributable earnings exceed the money they're paying out to shareholders, they have to pay Goldman Sachs back. It's like an IOU, and GSREFT needs to settle it, or at least part of it, as soon as they can. Now, if there's any of those distributable earnings left over that were not paid to the shareholders, they have to pay Goldman Sachs that overage amount. Now, GSREFT has until early 2030 to settle up, but the agreement could end sooner. What's interesting is that this obligation to pay Goldman Sachs back becomes a liability, a debt, for GSREFT at the end of each month. However, this doesn't count if Goldman Sachs says, "Don't worry about it, keep the money for the month." Now, what does this actually mean? Well, it could suggest that GSREFT might be feeling a little squeezed financially, needing Goldman Sachs to step in and cover some costs. On the other hand, it could be a smart move to manage their cash flow. Either way, it's something to keep an eye on. Next, let's talk about stock. GSREFT sold unregistered shares of its common stock in a private offering. This means they sold shares to specific investors without going through all the usual regulatory hoops of a public offering. The sale happened in early March. Here's where it gets interesting. They sold two classes of stock, Class I and Class S. They sold 862,700 shares of Class I common stock, bringing in about $21.6 million. They also sold 331,914 shares of Class S common stock for around $8.4 million. Now, the Class S sale includes some upfront selling commissions. The price of these shares is based on the company's net asset value, or NAV, from the previous month, plus any commissions or fees. If a class of shares isn't yet being traded, they base the price on the overall NAV per share. Also, GSREFT exchanged 2 million shares of Class I common stock for an equal number of Class FI common stock. This was for certain investors who bought Class I shares in the initial offering. Because this issuance of Class F1 common stock was an exchange with existing holders of the company's securities and no extra money was paid to convince people to do it, it was exempt or free from the standard registration requirements. Let's move on to distributions, those sweet payments to shareholders. GSREFT will be paying out distributions for February. The payments are expected around March 10. The gross distribution is the same for all classes, about $0.166 per share. However, there's a twist for Class S shareholders. They pay a distribution fee, so their net distribution is a bit lower, about $0.1497 per share. Class I and non-voting common stock shareholders get the full $0.166 fee-free. Remember, this applies to shareholders who were on record at the end of February. Lastly, GSREFT originated a $31 million loan in late February. It's a floating-rate first mortgage loan secured by two industrial buildings in Las Vegas. It's meant to finance the acquisition or purchase of the property. The loan has an initial term of 3 years and can be extended for 2 more years if certain conditions are met by the borrower. Payments are interest-only at a rate of 1-month term secured overnight financing rate, or SOFR, plus 2.80%. Basically, the interest rate can change depending on market conditions. So what's the big picture here? GSREFT seems to be making some strategic moves to manage its finances and grow its portfolio. The expense support agreement suggests they might need some help with cash flow, but it could also be a smart way to manage expenses. The stock sales bring in capital, and the Las Vegas loan shows they're actively investing in real estate. Now, let's break down my thoughts and analysis. GSREFT's direction seems a bit unclear. The company is actively making deals and transactions to generate revenue, however, the need for an expense support agreement is a possible weakness. This could indicate they need help with cash flow, but also it could just mean they are managing expenses in a smart way. It could be a sign of underlying issues. It really depends on the exact details, which are confidential to the company. They seem to be taking a measured approach to growth. The Las Vegas loan is a good sign. One notable risk is the floating interest rate on the Las Vegas loan. If interest rates rise, the borrower's payments could increase, potentially leading to default. On the other hand, there's an opportunity in the Las Vegas industrial market, which has been experiencing growth. If GSREFT can successfully manage this loan, it could be a profitable investment. In conclusion, Goldman Sachs Real Estate Finance Trust is navigating a complex financial landscape. While there are some potential weaknesses, they're also actively pursuing opportunities. It's a company to watch, especially if you're interested in real estate finance. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. What company should I decode next? Let me know in the comments.